So first piece, the co-author team. So George, who's looking a little bit stern over here, so actually a very, very merry fellow. So George was my PhD student when I was at Harvard X number of years ago. And those of you that know the ESG research space know George is a phenomenal researcher and has had an incredible career so far. So he's now a tenured professor over at Harvard. And the other two, Shirley is an assistant professor and Simon is a postdoc. And I met them and worked with them last year. I was on sabbatical at HBS. And this is just a little background story on what's going on. Harvard had put together something called D Cubed, and it was really just a research initiative to stimulate different types of research, not just accounting and finance based, which is what I'm going to be talking about today, but research generally in the climate space, in the climate change space, really from a business school perspective, so a business perspective. And so we talked about a couple of different things that they were doing. And one of the things that they talked about was they had worked on creating this thing called a climate solutions textual analysis measure. And that's going to be one of the primary things that we're looking at today. They have other papers looking at the dimensions of this. What's nice about the measure is that it's a text-based measure, and it aligns with some other text-based research that I've done with some other folks here at Questrom as well. And so we thought it'd be fantastic to partner together. George and I worked on a couple of other projects together, but we share an absolute passion right now for thinking about climate change and research related to that. So that's kind of where that got started. So that's me. That's me 4 months ago, kind of revealing my tree hugger love, right? So that was mile 326 on the Appalachian Trail with my daughter. So there I am. And so the four of us started working on this project. And so it's going to be this thing, notion of climate solutions, and it's going to have a finance angle. It's going to talk about transition risk and stock returns. So what are we doing? When you talk about climate solutions is this notion about companies that are engaged in things that I would characterize as the right tail of risk associated with transition risk. Most of the research that I've generally observed in accounting and finance literature is when we talk about transition risk, typically it focuses on the left tail. What would be an example? We're going to have carbon pricing coming, and then there's going to be carbon taxes, which is going to increase the cost of your business model, which is going to make it harder for you to compete. That's an example of a left tail risk. Another left tail risk is because of climate change, you have sea level rise, you have more hurricanes blowing through. That creates operating risk to my asset structure. That's left tail risk. There's a lot of research that talks about and examines the effect of climate change on left tail risk and how business responds to it. There's not a lot of research talking about the flip side of it. And risk is really a variance notion. And the flip side of it is thinking about, well, what's the upside? Is there an upside? And how do we identify it and try to figure out what companies are doing? And so climate solutions broadly is this idea of companies that are engaged in some type of technology, a product or a service that can take advantage of and leverage transition risk. That's what they're trying to do. Some examples are there: electronic vehicles, batteries, renewable energy, and the list can go on. When we talk about transition risk, what are we talking about? Transition risk can encompass a bunch of different things, but broadly what we're trying to capture is this idea of a climate notion, so a physical notion related to risk that I think most people, and certainly in this audience, will be familiar with. There's also a regulatory notion of it. So as governments start taking ownership of certain externalities, are they starting to pull in, create regulations that create different costs and opportunities for companies? Both of those broadly capture the notion of transition risk. There are other dimensions to it as well. What I've learned working a little bit in the risk area, you ask 1,000 people to define risk and they'll give you 1,001 different answers about what characterizes it. And a lot of them, they're generally not to be viewed in my mind as mutually exclusive. Many of them are very overlapping constructs. They capture very similar ideas. What we're really trying to capture with our notion of transition risk in this paper is simply the idea that if you have a state of the world where you're moving to low carbon, that's a transition that we're trying to characterize, and how are companies able to respond to that? That's what we're looking at. And so the loopy thing about transition risk is, again, I think we want to try to put a particular connotation on it, but I'm not sure how easy it is to really nail that down. It's capturing a lot what I think. What we're trying to test in this paper is this notion called the hedging hypothesis. And the hedging hypothesis popped up. So Pastor et al., Pastor is certainly a big time finance researcher, and had a couple of papers. And the broad notion is this idea that if you have certain types of firms that can take advantage of climate risk or transition risk because of the products that they offer, then they're in a better position to hedge against this transition risk. And investors are going to therefore perceive them that way and have a certain way that they price their shares. That's what the hedging notion is. Basically, there are a subset of firms that help me as an investor gain some type of exposure that's going to help me out in the event that we have a further move towards transition to a low carbon economy. And in part of that is going to be this idea that you're going to move towards, in that world, a higher demand for the types of products and services these companies would provide. So picture, for example, a world where if gasoline or some type of carbon-based fuels get taxed really, really heavily, right? Now, the companies that provide electric vehicles may be in a better position than the companies that provide internal combustion engines. That's the general idea, right? So it's not a particularly complicated idea, I don't think. And so what we're presenting in this particular paper is this idea that if you could come up with a measure and you could take all the firms and identify the subset of firms that have the most exposure to climate solutions. So again, to the right tail, they have opportunities, products, and services to take advantage of that. Then what would we expect? We're going to expect that those companies are going to exhibit higher stock prices and therefore lower expected stock returns, because as an investor, you're going to put a premium on those companies because of the hedge. That's what the hedging risk notion is doing. You're basically paying extra for those companies because they're giving you protection for a type of risk. And then the second thing related to that is that we're going to then try to document that beyond acting as that they have a premium to act as a hedge, then we're going to try to come up with a couple of different ways to document what happens in these expected returns, okay? So that's what we're doing in a nutshell. It's all really about trying to identify, again, a set of companies in the right tail. That's what we're trying to do. So probably the most innovative thing I think we're doing in this paper is this construct and applying it in this setting. All the tests that we're going to be doing are actually more or less off-the-shelf tests that some other finance paper or journal has actually published. So the big innovation is really the measure and just layer it on top of this particular story. So let me talk a little bit about climate solutions and what this thing is. So if you guys have played at all in the large language model space, what can you do? Well, what you can do is you can train these large language models and focus them on particular types of content that you can deliver. And in our case, what we're going to be doing is we're going to be taking advantage of a particular document. So we're focusing on what's called the 10K. And so all the accountants in the room will know what a 10K is. Many of you generally know what a 10K is. 10K is a US mandatory annual filing statement. So all publicly traded companies in the United States need to file an annual 10K. And the 10K has a bunch of different parts that are prescribed by the regulator, the Securities and Exchange Commission in the US. And one of those items is something called item 1. That's called the business description. And in the business description, companies, what they're charged to do is to basically provide an overview of their business. What are the key markets that they are participating in? And generally some description of the key products and services that they provide. And the idea is if you're an investor or a user and you're trying to understand the company, that description should give you a pretty good overview of what this company does and how it operates. That's the idea. And so what we like about this is a couple of things. So first, we think it's relevant. It's a legal filing, so companies are required to do it. They don't have the option to do it. They're required to do it. And it does give a description of something that we're trying to capture, which is the products and services that we care about. It has a higher bar in terms of reliability because it's subject to review by the auditors. It's subject to the review by the regulators. And then the CEO and CFO also have to have a sign off on it. Key also is this last piece here, this idea of self-selection. So if you've worked in the ESG sustainability space, particularly company and company disclosures, one of the huge problems that we face regarding them is this idea of self-selection. So if you guys are all a bunch of companies and you are going to publish a corporate sustainability report, the problem is you don't have to do it. You can opt in to do it. And so some of the ones over here are going to do it because you have some really great things to say. And some of you over here are not even going to touch it because you want to basically just not talk about the fact that maybe you're doing things that aren't that great. So self-selection is a massive problem when we think about certain types of disclosure channels that corporations use. The nice thing about a 10K is you get past some of that. Because it's a mandatory filing, you don't have the choice. You got to publish your 10K, you got to file it, and you got to talk about your business description. And our assumption is that if climate solution type products and services are material to your company, material being the key word, you got to talk about them somewhere in that business description. So if it's material to your operations, that's what you're going to do.
What happens if you misreport this type of things?
If you misreport, yeah. Well, I mean, now we go down what are the channels? So if you've deceived the auditor, if you've deceived the regulator, and you basically lied, right? So in this audience, we know about the term greenwashing, right? So Jesse Co sitting in the back, going to pick on, well, two Jessies actually, there's Jesse Co and Jesse Co. Very good. Okay, fantastic. So the both of you, and they decide they're going to talk in their business description that they're doing all kinds of investment in the space relating to renewable energy. It turns out it's absolute crap. They're not doing anything in it, right? So the first layer would be, is an auditor going to sign off on that? Probably not. Second layer is going to be a regulator. The SEC, there's a whole process by which in the United States, filings are reviewed annually by regulators. And so that's a second layer that goes through. If they get through all those layers, then what happens? Then you have the ex post settling up, which is if they touted this, and then it turns out on an earnings call or something, now an analyst says, hey, I see in your business description, you talked about all this renewable energy investment that you're doing. Can you talk about it? And then you get a dead zone. Then you've got legal jeopardy. In the United States, the legal jeopardy thing is a factor that mitigates misrepresentation. In other jurisdictions, not quite as much. However, the primary assumption that we're talking about with this measure really comes down to is the process, the filing process and overview process, getting you reasonably good information. If I had to put it on the continuum, so if I think about, come back to the self-selection, misinformation, and reliability. If I did this same project and I did it on CSR reports or something that we call in accounting, we call them voluntary disclosure channels, and I did it on that, then I think the probability of misinformation is wildly huge in something like that. In a 10K, it's not zero. I don't think you can get it down to zero, but it's going to be pushed down enough that I think it's not going to be a material issue.
What I was wondering is whether you can actually use voluntary disclosures and this to see if there's in fact
consistent story. I like that. I like that's a nice thought. Yeah, to think about that as kind of partnering them together. I like that. I like that a lot. Good. And then the last part with the solutions is this comparability thing. If you've run these text-based models, it's nice to have uniform structure in your documents. It allows them to kind of process the information in a little bit more consistent way. And so that's nice. So what do? We train a GPT model to identify sentences that are related to climate solutions. And the way we do that is it starts with a vocabulary, so a set of terms that would be used to trigger whether or not this relates to climate solutions. Think electric vehicle or something like that. But it goes another layer beyond that because the way the models are starting to get better and better is that they're moving away from just tell me if a word is there, which is kind of a yes-no type thing, to tell me if a word is there and now condition it on, is there another term that helps me understand it? Context is the fancy term that we might use. What that means is, so for example, the difference between, so here's one company and they're saying that we're going into electric vehicles and that we need to play in that market. Not the same thing as another company. We're already playing in that market and we're generating substantial sales from that. Even though both of those mention electric vehicles, right, the implication is very different. One company, it's actually a material part of their operations. For the other company, it's an aspirational part. And so this tool is, and the way that it was trained was to try to identify and put higher weight on the latter as opposed to the former. That's what it's trying to do. And so, and then you can use some fine-tuned data. There's something called project drawdown that I won't go into the details of it, but the basic idea is they gave a set of terminology that's been reviewed that helped you to identify what are the right terms to be using when trying to identify these climate solution notions. So what does this measure? And I'm going to throw it out. The academic qualification here. If this were a pure academic professor audience, this would be the part where you start cowering and getting ready for people to start ripping you apart. Because in the end, I think it's a good proxy. It's not a perfect proxy. What we're assuming, it captures the ratio of how many climate solution sentences there are as a percentage of the total sentences in the item one. And the simple assumption is that if you're a company and you spend more time talking about climate solutions relative to another company, then you should have a more material economic exposure to climate solutions. That's the simple assumption. That's what it is. What would we prefer to have? I would much prefer to have some measure that shows 30% of my sales come from climate solutions, right? Or 25% of my operating assets are focused on that. Those measures don't exist. Or if they exist, they're really noisy, and they definitely don't exist for a wide cross-section of companies. One other thing that's nice about this measure too is that it moves away from a selective population of companies that you can examine, because in the world of doing voluntary disclosures, like Nalin was mentioned, you've got a subset of companies because not everybody is doing it. That's why they're voluntary disclosures. What's nice about this is now you can do the full set of publicly traded companies, and that part is useful. It does make it more generalizable, but potentially a noisier proxy. So it's just a ratio. It's going to vary from 0 to 1. 0 is I never talk about climate solutions. 1 is I talk every single sentence about climate solutions, and everywhere in between. Simple proxy. That's all it is. Okay. One of the things that George and Shirley have done in another paper is basically a validation exercise, right? And so if you're an academic, if I was an academic and I was critiquing myself in the audience, the first thing I would say is, well, prove to me that measure is worth anything. And so the first paper that they have done was to validate it, show how it correlates with other measures positively, but not perfectly, which is exactly what you want, right? You want it to be capturing something moderately unique relative to other existing greenest type measures. It's a part of the paper. So I'll get to start some analyses in a second. There's within this amount of time, we have a lot of analyses in this paper. It's chock full of stuff. I'm only going to go through a couple just to give you a flavor for what we're doing. But one of the big things that we're trying to do is demonstrate that this thing captures something different than a whole bunch. There's 3 or 4 big measures that have been used in accounting and finance that capture elements of this. And we're showing that this thing captures something above and beyond. How do you do that? Easiest thing, you control for it in the regression is one way to do it. Second thing, you show the correlations, and on and on and on. So yeah, these are great points, Maxime. Thank you. Yeah, of course.
Just a quick question. Did you and your colleagues kind of read some of these reports and rank them yourselves and compare it? And how did that work?
Yes, we did. We did. So I did not do this. They actually did this. So outsourced. But in this part right here, in the training, one of the things that we did is, so you start with the vocabulary from a credible source. So the project drawdown is a credible source because it comes from a couple of research scientists focused in this area that defines the terms that we use. Then you apply it, and you can do a couple of things. You apply it in sample, then you get a holdout sample, and then you do a manual process, and then you do this process on top of it, and then you compare and contrast, and that's exactly right. And it was, oddly enough, I got to say, if you've worked with large language models, they're good, but man, sometimes you run them like, wow, what the hell is this thing doing? And sometimes they don't perform the way you think. This actually was pretty consistent. I was a little shocked by that. And for me individually, it convinced me that it's a good measure. It's not a great measure, but it's a good measure, and I'm pretty sure it's a unique measure. And that's for me important. Okay, great. Thank you for the questions. So let me just give a couple of examples, and then I'm going to go into some of the analyses we're going to do. So climate solutions, what is this thing? So let's look at Tesla and General Motors. And there, no surprise. So if you wind the clock back, so the sample that we're using goes from 2005 to about 2021 or so. And in 2005, that's the start point because that's when the SEC started mandating a certain structure for information that was provided to 10Ks related to risk factors. But it also coincides with the availability of some documents that we needed for our sample. So if you go back in time to 2014, what would you see? No surprise. Here's Tesla, and there's all the yellow, and lo and behold, Tesla, of course, is going to be a very high climate solutions type of company. You look at General Motors in 2014, and lo and behold, what do you see? All right, they're an auto company, really not going big into electric vehicles at that point in time. You fast forward a couple of years and look at Tesla, exactly what you'd expect to see, still doing it, and actually expanded kind of vertically in terms of what they're doing. And General Motors now is starting to talk about, and they've actually are starting to sell and develop electronic vehicles. And so use those two examples to illustrate two things. One, that you have over time variation. So companies are evolving and they're responding to market forces as we would expect they would. That shouldn't be too much of a surprise. Two, even within an industry, you can have really significant variation. And that's going to be important in a moment when we get to one or two of the tests that we do. There's a second section called item 1A, which is the risk factor section of the 10K. And in item 1A, companies are supposed to list all the material risks that the company faces. That's the SEC hurdle for that. The challenge is that that section generally is written by and overseen by the lawyers. And what do lawyers worry about? They worried about lawsuits, right? And how are we going to get sued? And so if you look at the overwhelming majority of risks that are shown in that section, it's the left tail. That's what they're talking about. They will talk about some right tail risks in there too, but it's pretty, and just, I encourage any of you, just pick up a 10K. It's oddly fun reading, actually. It's really, really cool. So Tesla had, I think, 50 risk factors listed out, and they range from Elon Musk disappearing off the face of the earth in some weird and unusual way to all kinds of other things, right? So, but if you read through, you do get a pretty clean flavor for what they're describing. And directionally, no question, risk factors is left side. And this, if we're going to capture right side, that doesn't feel like that would be the best place to do it. Let me put it that way. Okay, those are great points. All right. And let me just punctuate this, let me just talk about a company over time. So this is a utility company, AES. Some of you are probably familiar with utility companies. So AES back in 2012, basically a power generation type of company. And then you fast forward and you can see they're actually now within the utility space, one of the companies that's really proactive in terms of what they're trying to do with renewable energy. So these are all these paragraphs are all just direct cut and paste right out of the business description. It gives you a flavor for what we're trying to capture here, right? So again, there is an assumption that what they're saying in here is moderately true, right? That's an assumption. And if they're lying, then all bets are off. But that, I think the layers of oversight suggest that they can't be lying that much. There's grayness, but they can't be, I think, lying outright in these sections. So we have a climate solutions examples. We could see it varies within industry and it varies over time. Move on. This is capturing the time trend for the sample. I mean, the primary thing just to notice is that it's growing over time. That's fine. In the end, the scale over here, though, to be clear, it's this is in percentage terms, so 4%. So really, at the end, it doesn't sound like a lot. One of the things this is masking, though, it's masking the variation within companies. There are companies where that value really does start to crank up and crank up really quite high. Tesla would be a poster child for that, where you get values that are going to be 20, 30, 40%, right? So it really is company specific in terms of what the value is. But we just wanted to illustrate how this thing is changing over time. Again, to my mind, this is really not surprising given what we know what's been happening in the last 15, 20 years, right? Companies are just responding to the realities of this. So what I'm going to do right now is do, over 20 minutes, a quick walkthrough of 3 particular analyses in this paper. This thing could go on to about number 7, 8, or 9, because there's a whole bunch of other things that we're doing. Don't have the time. But to get the flavor of what we're trying to accomplish within the paper, I think these 3 are fine and will be illustrative. And so one's called a portfolio analysis, one's a firm level return analysis, and one's an event study. And what we're going to try to conclude at the end of all this is kind of convince you that if you got companies that are high on this metric, so I partition you guys as example companies, you guys are going to be low and you guys are high. So you guys on this side of the room have more exposure, more products, more services that could take advantage of climate solutions. Then what do we observe? First, we're going to observe this idea that they're going to have lower future stock returns. Again, that investors are going to basically embed in your prices, your stock prices, a premium, and they're doing it because they view that you provide a hedge against transition risk. Therefore, you trade at a premium, which means that your future return is going to be lower because you're already trading at a higher price. That's the idea. And the second thing that we're going to do is we're going to try to narrow down the return window, a short-term return window, and show how companies, how they defer in responding to shocks in terms of transition risk. Because risk is not static, it's dynamic, it's constantly moving and changing. And if you followed the election a week ago, you have a pretty good idea of what we're talking about, right? Something just changed, you get a new administration, all of a sudden what was the day before the election is now potentially very different because of a new administration coming in. And there are some examples of that. So let me get through and start talking about the analysis. So this portfolio analysis, this is, again, we're not creating anything here. This is a fairly standard off-the-shelf finance approach to doing some type of portfolio return analysis. We're following this particular paper, and the process is fairly simple. What you do is you take your firms and you're going to pop them into 5 quintiles is what you're going to do. And you're going to base it on the climate solutions as of the beginning of the year. So the beginning of the year, and we're going to look at stock returns over the ensuing year. So we know that the market has that information because we're deriving it right out of the 10K. That's the assumption, okay? Critically, I want to highlight this thing right here. It's done within 4-digit GICS code. What does that mean? What we didn't want to do is write a paper that just captures that certain industries are being more proactive about engaging in climate change and solutions relative to other industries. That's really not the point of the paper. The paper's point is to identify and show that there's a lot of variance, heterogeneity. Some firms within an industry are taking advantage of it, and some firms are doing less so. And can we exploit that? That's what the paper's trying to do. So all the portfolio structure that we do is all within. When we set them into the different quintiles, it's done within industry. We've got the low portfolio is going to be the low climate solutions. High is going to be the highest value. Again, it's done within each industry group. And then once you set up the portfolios, pretty simple structure, then you just see what happens to stock returns over the next year, the ensuing year, right? That's the future stock return that you're looking at. Then you rebalance after a year, and you repeat the process. That's what this is. And again, it's a pretty standard approach. And the goal here is to assess a high minus low portfolio, right? So if you're just thinking kind of in the abstract, what you're trying to do is you're trying to set up, imagine if I could overweight or underweight firms based on some type of underlying risk exposure that they have, then what would I do? And in this world, what you're going to do is you're basically going to go long on the high climate solutions and short on the low climate solutions. That's how you structure your portfolio to take advantage of this. So let me show you what it looks like. So this is the one table on portfolio analysis. And, the first thing to note is a lot of numbers up here. The first column and this 5th column right here with the red circles on it, if you guys are online looking at this, the L and the H that reflects the low and the high portfolios. And that's the columns of focus that we care about. And really that column on the far right, that's the difference. That's the long short portfolio investment that you do. So it's the difference between L versus H is sitting right here. That's what I'm going to be talking about. And if you look at that last column, what do you see? All right. Well, you see that there's a negative 0.45. What does that mean? That's your excess return, your excess annualized return. And so what that's telling you is that if you look at the 2 portfolios, look at the L and the H, over the next 12 months, the low has a 0.97, high has a 0.52, low has a higher return relative to the high portfolio. What does that mean? You guys that are the high climate solutions firms, you already have a high price to begin with because investors are putting a premium into your stock prices because you're providing a hedge. over the next 12 months, you're going to basically by mechanics, you'll have a lower return because it's already embedded in your price. And you guys over here, you're the low climate solutions company because you're not providing me any value in terms of providing a hedge against this risk. You're going to exhibit the higher return. That's the difference that you observe in this column right here. Okay? It's predicated, when you think about how you do it, it's all predicated on how do you build the low and the high. That's what it's all predicated on. You need something, you need a measure, a construct that can sort companies into the portfolios. What we then do, I mean, this is what academics do, right? We just beat the hell out of each other and say, all right, here's some data, and man, if you're going to prove something, you got to run it 14,000 ways. Here we go. And so the rest of this table is just showing alternative results. So run it through a CAPM, 3-factor from a French, 4-factor, 5-factor, and we do other things in the paper as well. The basic intuition is the same thing. And the intuition is that for companies that are high climate solutions, those are the companies that are exhibiting the lower expected stock returns, consistent with the story that investors are putting a premium into their prices because they act as a hedge, right? We're going to go a couple of steps to try to prove that more, but that's the first piece of it. Yeah. We're going to have another set of analyses that talk about how companies' actual performance occurs, right? So that's a way to validate that. There's a couple of other tests that we do to try to control and build out the performance part of it, the underlying economic performance. Absolutely. There's a set of analyses that we do that we're not going to talk about because I've only got you guys for 45, 50 minutes, but there are a whole set of analyses that we've done to basically answer that exact question. I think it's an important one.
So the assumption is that it gets priced in completely at the start and nobody changes their risk assessment over time to like, I'm just asking.
It's a good question in the sense that, right, so whenever you do any type of study where the variable you're looking at is some type of market outcome variable, in this case, it's stock returns, right? You got to take a little bit of a position of, well, is the market operating pretty well, i.e. efficient market, or is it not operating so great and I can't trust price and it's just fluctuating? What we actually do as another part of the paper is try to rule out the market is not working the way it's supposed to. We would call it the mispricing hypothesis. So that's another way to interpret this data. And we actually do another set of analyses to rule that story out because that's an important story. So it's, again, these are, you guys picked up on the two threads that are things that you need to do to basically validate the result and interpret it the way we have to. Yep. Okay, so that was the first of 3 analyses that we do. Let me show you the second analysis. The second is, it's really kind of a similar and derivative analysis of the first. Instead of using portfolios, use a firm level regression. Here's the process right here. So just imagine every month you've got a set of returns. And what you're going to do is regress these returns. It's going to be in excess of the risk-free rate. You're going to have the variable, the climate solutions variable, and then you can control for everything under the sun is what you're going to do. And it's basically a way to try to control for more explicitly other factors that you think could drive returns. That's at heart what you're trying to do. We also do a fixed effect structure, fancy term in academics to just say maybe the time, the period matters, so you control for that. Maybe the industry representation matters, control for that. And so let me show you what we got. So if you have good eyes, you can read that, but I don't, so I'm going to do that. So just capturing the first variable at the top here, and just kind of pay attention in terms of what this regression is doing. So the dependent variable up there you see is returns. It's returns T. It's kind of the next month returns that we're looking at is what we're doing. The CS measure, the climate solution measure, that's T minus 1. So that's what the market knows at the beginning, and then we see what the return happens afterwards, okay? Very similar in spirit to what we're doing with the portfolio analysis. And what we see, you got these negative coefficients. The 3 columns are just different ways to do the regression. So throw in these control variables and then more control variables and then the fixed effects and all these things. We run this 5,000 different ways. Broadly, the story that you get is that this thing is coming through pretty consistently negative, actually very consistently negative. This result is similar, in fact, virtually identical to what we are getting with the portfolio analysis. And what does it tell us? It tells us that this set of companies still with the high climate solutions they're exhibiting a lower future stock return. That's what it's showing, okay? Again, consistent with a pricing premium and a hedging story. Got to keep repeating that. So this is just another off-the-book, off-the-shelf analysis that we run. Okay, final thing is the event study. I happen to really love doing event studies. I've done a bunch of event studies on different types of regulation, both in the ESG space and in other regulatory spaces. The basic idea is that instead of looking at a long window, a month, 6 months, a year, you collapse it down to a couple of days, and you're looking for a shock, something that happens. And once that shock hits, everybody in the marketplace looks at it and says, oh my God, I got to reformulate and rethink because this is something I didn't know yesterday, and that's going to change the way I think about the world. And that's what a short window stock return study is going to do. What we do is we do 5 events. And Helen, this is going to try to come back to what you mentioned before. I don't know if it's exactly going to get to it, but let's see. So the 4 events that I have listed here, these are events that happened during our sample period that we viewed as having a measurable impact on transition risk. Now, they affected other things as well. But keep in mind, what we're doing is we're thinking about how this affects high versus low climate solutions companies, right? So it's got to go through that channel. So clearly, other things could be going on in these events as well, but it's got to vary systematically with the measures that we're looking at, the climate solution measure. First event is Massachusetts versus the EPA. And at that point, that's the EPA mandated Congress or mandated by Congress that greenhouse gas emissions from motor vehicles are going to be regulated, right? That feels like an example of transition risk getting elevated. Now car companies, automobile manufacturers have to do things to try to accommodate that, and regulator, the EPA is now going to oversee emissions from their vehicles, their products. The Paris Agreement, 2015, most of you might be familiar with that. That was the big signatory event with many countries signing on to recognize climate risk and elements related to that. Joe Biden got elected in 2020 and reversed some expectations regarding US environmental policy. IRA relates to the Inflation Reduction Act, and included in that act was a bunch of subsidies related to climate-related solutions. And of course, you got to have an event going the other direction. And our event going the other direction is Mr. Trump was elected also back in 2016. And that also based on his platform at that time, probably this time too, quite honestly, is that probably a pullback on regulations related to that and basically regulation risk going down regarding to the transition. And so broadly, what we're doing with these, we're viewing 4 events as pushing transition risk higher. And then the one event, the red event, as pushing transition risk lower. So we've got 5 events, and these are shocks, right? So at the time, just on April 1st or March 31st of 2007, did we know that the EPA was going to be responsible? Might have had an idea, but once the final decision comes out by Congress, then it gets legislated, and now something has changed. That's the spirit of what an event study is trying to do. Jesse, you had a question.
So for the 2020 election, is the choice of December date kind of later in the certification process that year, or
yes,
what's the rationale there versus using the November, not November 8th because it took a couple of days, but the November?
I thought it was the certification idea.
The date that you spoke and announced that you applied.
Yes.
So that's the reason is
yeah, yes, exactly.
Waiting later. Okay.
Exactly. Yeah. If you guys probably remember pretty well what happened that particular election. Right? There's a lot of controversy about counts and vote counts. Yep. Yes. When we went through events that we could use, we're not sure if that we're able to peg a specific day when the US did a withdrawal from a particular large legislation like the Paris Agreement. So we weren't comfortable. Event studies by their heart are predicated on, do you have a clearly and well-specified event? Do you know that this was when the market learned about something? And if you don't have that, then it's going to make the measure much more noisy. And that's why I don't think we included that. But I think you're right that Trump's administration, certainly there's pullback on a lot of different things, but we're using the election as kind of a catch-all of expectations of him pulling back on legislation. Does that make sense? Okay, thank you. Mm-hmm.
Oh, I was just thinking, is it possible to go at this event study in the opposite direction, to use some objective procedure with your data to see when things actually change and then try and relate them to events rather than kind of choosing events and seeing whether they affect, see whether there are actual changes in returns in the data and going that direction.
It's a really interesting idea. I'm so kind of drank the Kool-Aid of how event studies are done, where you get the event and then you test the event as opposed to going the other way. I don't see any reason that you couldn't do that as a way to try to validate certain events popping up. Yeah, the sausage making that is event studies is really, it's moderately complex. You're assuming that the market didn't know things before July 27th and start pricing things in early. You're assuming that within a reasonable time frame, they can kind of get it together and do some type of reaction. It doesn't take a while to digest the information. So there's a lot of underlying assumptions when you do an event study. Absolutely the case. So just as an example, earnings typically, they're front run by multiple things. Analysts are front running it because they're putting out projections. Managers are putting out management forecasts. And so the earnings can actually come, the earnings day, it's like, who cares? We already knew about it, right? There's nothing new. So that all depends. One thing it does do, just in hypothetical world, if these are real crap measures, let's say in hypothetical world, that the market knew everything that there was to know in the week or 2 weeks or month before this, and these events are non-events is what that means, right? There's no information there. There's no reason it should vary across the high and the low climate solutions because the market already knew it 2 weeks ago. That's the idea. Typically, in academic speak, we say that should bias you towards the no is what it should do. So let me show you the results, and then I just got one more slide, and then we wrap up. So here are the event study results. And if you want, just focus on the top row right there. And just like we did before, we partitioned the companies into the low and high portfolios, just like we did previously. First event was Massachusetts versus the Environmental Protection Agency. And what do you see? You see that for the low, that there's, and again, think about the event and what happens on the event. On the event, the regulator was given more jurisdiction coverage over managing greenhouse gas emissions. That was the basic tone of the event. So that increases transition risk. It's going to be more expensive and more important to have exposure to climate solutions. If you're low, that was bad for you. So you guys that are in the low group, that's not good for you as companies because now you're in a business and you don't have the exposure to the upside of the climate solutions. If you're high, positive, not significant. But again, in this construction, what you care about is not what's happening in the individual portfolios. You care about the difference across the portfolios. In the difference, you get the positive, the 1.77. That's showing you that one group is performing differently relative to the other group. That in fact, the high climate solutions companies are responding more favorably now that we have a shock that says transition risk just became more important on that particular day. If you come and look at the other events, basically the same thing. You can see the ones in green correspond to the ones that increase transition risk. Paris Agreement, for example, that side, lo and behold, you have a very positive difference. Ditto on Biden's election, ditto on the Inflation Reduction Act. You see the Trump election, and what happens? It actually flips the other way. Now it's negative, which totally makes sense. If Trump's election means that transition risk is now less important because he's going to pull back on regulation, that should be good for the low climate solutions firms and worse for you because he's just basically doing things that's going to pull out demand for the products that you're trying to focus on. That's all that means. Okay. So those are the three sets of studies that we've got or analyses, and we do a whole bunch more. What do we conclude from this particular thing? And then I'll wrap up with a conclusion. High climate solution firms, what do we see? We see that when there's a shock that's a positive shock to transition risk, they respond more favorably. When there's a shock that's a negative shock, meaning transition risk just got lowered, they respond more negatively, right? Again, consistent with this hedging type notion. We do a whole bunch of other things in this paper. And again, we do not have time to get into all this stuff. We have a whole analysis talking about future profitability. We have 3 analyses trying to rule out mispricing as an alternative explanation. And there's also a clientele explanation about investors maybe favoring certain types of companies versus others. And so we go into all that. But the primary thing I want to give you from this particular paper and what we just talked about is a couple of things. First observation, companies that have the high climate solutions, they exhibit the lower expected stock returns. It suggests that they have a better capacity to hedge against transition risk. Stock prices also react positively to more stringent regulation. We do the shocks, the events, and lo and behold, they also respond more favorably to those. Here's a whole bunch of things that we do that we didn't even talk about. But the hope is that this paper, this series of papers, is really to start getting people about there's not just a left tail in terms of the risk opportunity, the risk cost, the downside. There's also a right tail in terms of what are the opportunities. We're trying to do some research to give us some insights about that. Are there any